Today, we are going to talk about the three reports that move billions of dollars every single month in the market. So, if you know me, I always tell if somebody is starting out in the market, you want to learn what actually moves the market. What are all these reports? What are these things that everybody talks about it, right? So, if you trade without knowing about these, it's like trying to drive into a new city without the GPS in the dark. So, not really a smart idea. So, I'm talking about is the FOMC, the one that sends the market into a roller coaster ride, right? CPI, the inflation report that makes investors either celebrate or cry. And then the third is PPI. CPI's less famous cousin, but still very powerful. So now most traders have heard these terms, but here's the truth. Most of them don't know what actually these reports mean. And most of them have no idea how to actually use this information to make money. So for context, I've been trading for over 5 years and I have built my account up from scratch. And in my gift community, I've helped hundreds of traders navigate these exact market moving events. So yeah, I've learned a thing or two. So by the end of this video, you're going to know what each report means and when they happen and the exact strategy I use before and during and after these announcements. And I promise I'm going to make this super simple so so even if you're brand new to trading, you'll get it. I know my English is ESL, so it's gonna be very simple in simple terms that you will definitely understand what exactly each of these reports mean. I've done some whiteboard videos in Instagram, but this one I am going to go a little bit more into detail on each one of them. How do they actually move the market? What do they mean for the market? And why does the big investors pay attention to these? So let's get into it. So the first one up is FOMC. So it stands for Federal Open Market Committee. Fancy name, right? But here's all you really need to know is it's basically the part of the US Federal Reserve that decides the interest rate. So think of them like captains of the financial ship. They decide, do we speed up the economy? Do we slow down the economy? Do we hit the brakes completely? Why does this matter to us as traders? Because interest rates affect everything, from stock prices to the value of the dollar to whether people spend or save. When does FOMC happen? 8 times a year, usually on Wednesday at 2 p.m. Eastern. And trust me, when the clock hits 2 p.m., markets can go wild. So what actually happens during the FOMC? First, they release the statement with their decision, raise rates, cut rates, or keep them the same. So then 30 minutes later, the Fed chair holds a press conference. Sometimes the statement is boring, but then the press conference has a small comment that moves the market like crazy. Everyone is listening, paying attention to, is Fed hawkish or dovish? What is their tone, right? Whether they decided on the rate going up or down, they're looking for what is the futures gonna look like, because that's what they're deciding it on, if the market's gonna go up or down. And so how do I trade FOMC? I usually avoid opening a big position right before the announcement. It is too unpredictable. Instead, I watch for the first 15 to 30 minutes, after the minutes have been released. It gives the market some time to digest what they are saying and what actually, the investors are looking to hear from it. And then market really makes the real move. That's where I find my trades. Next is CPI, aka the Consumer Price Index. This is just a fancy way of saying how much more expensive is life this month compared to the last month. If you have noticed your grocery bill or gas prices going up, congratulations, you have personally experienced CPI. So why does traders care about CPI? Because CPI measures inflation, and inflation affects the interest rate, and interest rates affect, you guessed it, stock prices. If CPI is higher than expected, it means inflation is running hot. The Fed might raise rates, market might drop. If CPI is lower than expected, inflation is cooling, and the Fed might relax or hold the rates as it is, right? The market might rally on that. So when is CPI released? See, once a month, usually around the middle of the month at 8:30 a.m. Eastern time before the market opens. So how do I trade CPI? Step one, check the forecast. Economists usually predict the number before it comes out. Step two, compare the actual number to the forecast. And step three, watch the first 15 to 30 minutes after market has opened. Then I look for my setup, because that gives the market to digest about the report, whether it is flat, up, high, low, whatever it is. And my pro tip is sometimes the market makes a big move in one direction only to completely reverse within the 15 to 30 minutes. So that's why waiting that 15 to 30 minute at the open will help you a lot. This is happening because the big players wait for the retail traders to jump in and then take the opposite side of it. Now let's talk about PPI. So PPI stands for the Producer Price Index. This one is like CPI, but instead measures prices for consumers. Producers pay for the materials and goods. So why should we care? Because if it's costing the producers more to make things, guess what? They are going to pass that cost down to us, right? It goes down to the consumers. They're not paying out of their pockets. That means PPI can be a leading indicator for CPI, right? If PPI is higher, then obviously it's affecting CPI, and CPI is going to be probably coming in hot as well. So when is PPI released? Usually the day after CPI at around at 8:30 a.m. Eastern. So this is also released in the pre-market. How I trade PPI? Again, I follow pretty much the same rules I follow for CPI. I use it more as a confirmation for my inflation outlook. If both CPI and PPI are rising, strong in inflation, more reason to expect rate hikes. Bearish for the market, they might not even raise the rates, but market will react some sort of way that usually isn't taken as positive. If both are dropping, that means inflation is cooling and bullish for the market. Fed might hold the rates or they might lower the rates as well. So they kind of go hand in hand. So this is the first part of where I'm talking about FOMC, CPI, and PPI. In the next videos, I am gonna break down, it's gonna be a couple parts of the videos where I'm gonna break down all the indicators of the market. As someone who is getting into the stock market should know how and why does these reports affect the market, what as a trader we need to know. So here where it gets fun, you don't just look at FOMC or CPI or PPI, you combine them, right? Example, CPI shows high inflation, PPI also high. Next, FOMC likely rate hikes, bearish market, or CPI low, PPI low. FOMC might pause hikes, so bullish for the market. It's like building a puzzle. One piece doesn't give you the full picture, but put all three together, you can see where the market might be headed. So that's how you use FOMC, CPI, and PPI to trade like a pro. These aren't just boring government reports. They are like monthly treasure maps for traders. The more you understand them, the better you can position yourself ahead of major market movers. Even if you're a long-term investor, this can truly help you. If this video helped you, hit that like button, subscribe, and comment below. Tell me which of these reports you're going to start paying more attention to it. And if you want to go ahead, learn more about it, or go more deeper into how I trade, how I look at things, or how I watch the market, there is a link in the description for you to join our community. Thank you, and I will see you guys in the next video.